fourth straight year, the U.S. insurance industry reduced its hedge fund investments. Here to discuss the sustained trend is Jason Hopper, Associate Director, Industry Research and Analytics, AM Best Rating Services. And Jason, why is the industry reducing their hedge fund holdings?
Hi, John. As you alluded to in your opening, this is the number of consecutive years that the insurance industry has reduced their hedge fund holdings. They dropped 18% in 2019 year over year, which now puts the insurance industry a little under $12 billion, down from about $25 billion in 2015. The majority of the drop has been led by the PC segment, predominantly AIG, both on the life side and the PC side. So not only is book adjusted carrying value declining, but the number of holdings has been declining as well. So it is heavily driven by dispositions. Back in 2015, there were about 1,300 hedge fund holdings, and that is down to about 900 now. But I do note that holdings are not widespread throughout the insurance industry. Only about 10% of our rated universe invests in hedge funds. So it is a relatively small proportion of the total industry. But in general, insurance companies have been pretty much singing the same tune for the past number of years, whereby returns haven't been favorable enough to kind of meet the high fees as well as the regulatory capital strain imposed by capital charges and things of that nature. So hedge funds just in general have becoming a little less attractive compared to some other investments given the returns.
So among the different hedge fund strategies, which one saw the most notable shift in 2019?
Historically, long-short equity was one of the more predominant hedge funds that insurers look to invest in. That dropped by about $2 billion, a little under $2 billion in 2019. Multi-strategy, another relatively popular in terms of higher allocations, is also down about $600 million in 2019. As I said, both of those were top strategies that have reduced holdings. On the other hand, sector investing does remain popular, and we believe that distressed securities might see somewhat of an uptick as the economy tends to flow through a bunch of companies, and many companies will now be a little bit more distressed. So hedge funds might be try and capitalize on that.
Now, generally speaking, where are companies reallocating the funds that were previously put into hedge funds?
So I don't want to necessarily say that hedge money previously going to hedge funds is now distinctly going to some other investment asset class. I don't think that's necessarily the case, but hedge funds are an alternative type investment. So we have seen a shift to private equity, which we believe is up about 9% in 2019. I guess just some other asset classes. Commercial mortgage loans remains popular, although we expect that asset class to get hit a little harder than it historically has been with all the mortgage-related issues. Commercial mortgage-backed securities are up slightly in 2019, and other types of structured investments, mainly driven by CLOs, also increased fairly substantially.
Now, Jason, given the COVID-19 driven market disruptions, what does AM Best expect on hedge fund investments or alternative investments as a whole?
Yeah, I mean, it's a little difficult to make any sort of predictions in this current economic environment. Obviously, many different asset classes are going to feel pressure from various angles, whether it be muni bonds or the general corporate bond portfolio, CLOs, commercial mortgage loans, as I had already mentioned. So I think companies will continue to invest in alternative assets, which in general hedge funds are a part of. So they use alternatives as a general diversification mechanism. So we don't think that will drastically change too much. It's kind of just what meets the needs of specific insurers on a case-by-case basis, whether they have the investment expertise to kind of continue to branch out in some of these alternative asset classes. Mainly driven by the larger companies with more experienced investment shops and things like that. But I imagine many companies are looking at their total investment portfolios and trying to figure out a way to navigate through this current environment.
Thanks, Jason.
Thank you, John.
That was Jason Hopper, Associate Director, Industry Research and Analytics, AM Best Rating Services. I'm John Weber for AM Best TV.